Let's bring in Greg Tuorto, Managing Director and Portfolio Manager at Goldman Sachs Asset Management. Greg, it's good to have you here on set. And that's exactly where I want to start. The fact that small caps have been underperforming. Obviously, we have this tariff news. We've seen the dollar weaken today in the midst of all the trade angst and growth scare concerns for the market as well. Do you buy here?
You know, I think you have to. I think you have to start legging into small caps. It's been a number of years of underperformance. I think one of the largest, headwinds, especially over the last couple of years, was rates. That's out of the way right now, and I think that should be turned into a tailwind. The growth scare narrative is something that is, that we have to get through, but I do think it's a buy right here.
Why do you think the rates piece of it now turns into a tailwind? We know the Fed, at least for now, is sitting on its hands. Is it just because the bond market is actually sending yields lower?
Yes, and I do think that point of friction with small caps does tend to kind of hold people back at the index level. There's an old saw about small caps that they don't have the best balance sheets. They're exposed to floating rate debt. So the higher the rates are, it does impact their cost of borrowing. It hurts their cost of doing business. So I do think that generally speaking, it does kind of create a little bit more attention to what the end calculus could be for what the return should be.
Help me understand, Greg, why the pros in small caps in the medium term even outweigh the cons. Because I'm thinking of cons, you mentioned higher rates. I'm thinking they got less scale to absorb costs. Maybe they've got less budget to get into something like AI that could deliver some shorter term productivity enhancements perhaps. But then they've got more domestic business, I suppose, on by and large. So they're going to perhaps be hit by some of these international effects less. But what else?
So I do think you hit some of the big ones, and I think that it's kind of a commercial for active management because you can stay inside the kind of color inside the lines of the companies that will be less impacted by some of those tariffs. When we look through our universe, the companies, some of the soft lines retailers, some semiconductor capital equipment companies may be impacted a little bit more from this new wave of tariffs we're seeing. But for the most part, I don't think that it's going to change the kind of the business plans that most of these CFOs laid out 6 months, 3 months ago. And in addition, if you look through sort of some of that domesticity that you just mentioned and what we talk about a lot, I still see the consumer as while they're saving a bit and weather has been tough for some of the restaurants year to date, I do think that there's a good demand picture as you go throughout the rest of the year.
But the working class consumer has been strapped. Mm-hmm. And one wonders, given how big an employer smaller businesses are, if tariffs have an impact on them and then it starts to inflect employment with a working class that's already stretched, what happens? Is that a danger for small caps in the economy?
It could be a risk factor. We haven't seen it or heard it from the companies who've just gone through an earnings season, a significant amount of earnings. You're not hearing that there's kind of any job cuts out there. As a matter of fact, most of the surveys we see from small cap executives are quite bullish, even through the last few weeks. So I do think that there's no real danger of job loss from the small cap companies. And I do think that if you start to think about the employment picture and, we kind of bring in some of the worries about, kind of federal jobs that are lost, I still think employment is pretty solid. And if people are employed, I do think that they will spend.